Behind all the dazzling headlines about artificial intelligence, there's this financial story unfolding that is, well, it's almost too big to comprehend. We're talking about staggering investment, immense risk, and a high-stakes bet on the future. And that's exactly what we're going to dive into right now.
So let's just start with a number. How about $650 billion? By the end of 2026, just 4 companies, that's Amazon, Microsoft, Alphabet, and Meta, they're projected to spend that much on capital expenditures. And yeah, most of it is for AI. To put that into perspective for you, $650 billion is more than the entire gross domestic product of Argentina. This isn't just your standard corporate investment cycle. No. This is a global economic event. It's an unprecedented gold rush for the digital age.
So what in the world is driving this? Well, it's a massive, all-in bet on what a lot of people think is the next great technological revolution. But you know what? It's a bet that's fueled just as much by fear as it is by greed.
Think of it like this, right? The biggest names in tech are all locked in a room. In the middle of that room is a big button labeled AI dominance. Now, pressing it costs billions, but if your competitor presses it and you don't, you risk becoming the next MySpace. So what does everyone do? You guessed it. They all press the button every single time. This is a race motivated by the absolutely terrifying fear of being left behind.
Now, the logic behind all this spending, at least on paper, it seems pretty clear. The argument is that AI is a general-purpose technology, on the same level as electricity, a technology that could add something like $25 trillion to the global economy. So these companies, they aren't just building apps. They're building the entire intelligence grid of the future. And for the last couple of years, the market has loved it. Spending money became a signal of ambition. But that ambition, it comes at a price. A staggering one, actually. And it's now putting immense financial strain on even the wealthiest companies on the entire planet. So let's talk about the other side of this paradox.
To really get the problem here, you have to understand one very important metric: free cash flow. Basically, it's the money a company actually gets to keep after paying for everything it needs to run and maintain itself. See, you can play games with earnings reports, but you can't fake cash in the bank. It is the ultimate truth serum for a company's health.
And this is the core of the crisis. Companies have a fire hose of cash just gushing out to pay for AI servers, new data centers, and these massive energy contracts to power them all. But the money coming in, from customers actually paying for these new AI products, that's more like a garden hose. And here's the really crucial point. That gap is growing. The result is what's being called a free cash flow shortage. And it's hitting the very companies that everyone thought were these unshakable financial fortresses. Recently, market stalwarts like Microsoft and Oracle were actually downgraded by analysts for this exact reason, citing structural AI risks.
One analyst put it perfectly. Finding out that Microsoft has a cash flow problem is like finding out your bank doesn't have a vault. It shakes the very foundation of the market. And this, right here, this is the moment the vibes market, where you could just say AI and your stock would shoot up. That market officially ended.
This whole situation, all the hype, this massive infrastructure build-out, the big questions about making money from it, it all has this chillingly familiar echo to it.
Really? You have to ask yourself, haven't we seen this exact movie before? The answer is, oh yeah, we have.
Remember the late 90s? Companies spent billions and billions laying fiber optic cables all across the globe. They were right. They correctly predicted the internet was the future. But what they got wrong was the timing. They built so much capacity so fast that they literally spent themselves into bankruptcy building the very infrastructure that we all use today. And the data we're seeing today suggests a really similar disconnect. Get this. Of the 450 million commercial users of Microsoft 365, only 3% are actually paying extra for its new AI features. That is a huge gap between how much is being invested and how many people are actually adopting it. Okay, so what happens if this spending has to slow down? Well, the pain doesn't just stay with big tech. The first domino to fall is hardware. Cloud providers make up about half of NVIDIA's data center revenue. So if they tap the brakes, the entire supply chain gets a haircut. Then there's the wider market. The S&P 500 is so top-heavy with these few names that if they sneeze, everybody gets a cold. And that includes pension funds, which have been treating these tech giants like safe utilities, not the high-risk ventures they're kind of starting to look like. All of this is building toward a moment of truth, a deadline where these massive bets have to start showing a real return on investment. A reckoning is definitely coming.
But there's one giant that is conspicuously absent from this spending war: Apple. While its rivals are projected to spend hundreds of billions on CapEx, look at Apple's spending. It's just a fraction of that, at only $12 billion. They're keeping their powder dry.
Apple's strategy is completely different. It's staying asset-light, generating massive free cash flow, and giving it back to shareholders. While everyone else is fundamentally reshaping their financial DNA to chase AI, Apple is just watching from the sidelines. The big question is, which strategy is going to prove to be the wiser one?
And this really gets to the heart of what smart investing is. See, historically, companies that outperform their peers, they do invest more, but they also get much, much higher returns on those investments. The question for big tech right now is a crucial one. Is this AI spending the mark of a smart outperformer, or is it just reckless overinvestment?
This is all building to a climax, and the timeline is becoming pretty clear. We've all lived through the vibes market. But now, as we head into 2026, the story is changing. Free cash flow is king, and that sets the stage for 2026 and 2027 to be the moment of truth, the moment when all the promises of AI have to finally convert into proven, sustainable profits. So look, the AI-powered future we've all been promised, it is absolutely being built right now with concrete and silicon and hundreds of billions of dollars. There's no doubt about that. The only question is, when the bill finally comes due, who's going to be left to pay for it?